Earning an extra $25,000 in retirement sounds great, till you realize how little of it you actually keep. For a lot of retirees, it's barely half. Let me show you how. Meet Doug. He's 68. He and his wife Linda retired 3 years ago in Ontario with about $95,000 a year coming in under his name. Last spring, a former colleague called and asked if he'd come back just 2 days a week, only about $25,000 a year. Of that $25,000, he kept a little over half. Not because he did anything wrong, just because of how retirement income stacks. Doesn't mean he shouldn't have taken the work. Part-time work in retirement is often a very good idea, but Doug made the decision without knowing the real number. I'm Kris Dureau from Green Private Wealth, and I'll show you where the other half went and what Doug and Linda could have done differently. Most people get one thing wrong about part-time work in retirement. They think about the income on its own, but you don't earn it on its own. You earn it on top of everything already coming in. CPP, old age security, your pension, your RRIF withdrawals, interest and dividends. So it isn't the first dollar you earn that year, it's the last one. And in Canada, the last dollar you earn is treated very differently from the first. So let's follow Doug's $25,000 and let's watch what happens to it. First thing that comes off is ordinary income tax. Ontario in 2026 at his income level, that's roughly 31 cents on the dollar. That part everybody expects, no shock there. Here's the part they don't. Your old age security has an income test. Once your net income passes $95,323 in 2026, the government starts taking OAS back. 15 cents for every dollar above that line. Officially, it's the OAS recovery tax. Doug was sitting at $95,000, almost exactly on that line. So essentially, every dollar of that $25,000 landed in clawback territory. His income went to $120,000, about $24,700 over the threshold. At 15 cents on the dollar, roughly $3,700 of his OAS gone. And here's the thing, the clawback doesn't replace his tax rate, it stacks on top of it. 31 cents of tax plus 15 cents of clawback, 46 cents on the dollar. And that's where anything came off his paycheck. We'll get there, because there's a decision hiding in that most people don't know they have. So that's the bad news. Here's what matters more. Doug's number wasn't fixed. There were 3 things he and Linda could have done, and every one of them was available to them. Before we get to those, take 30 seconds on your own. First, add up everything you'll report as income next year. CPP, OAS, pension, your RRIF minimum, interest, dividends, capital gains, maybe you got some rental income. Where does that land relative to the $95,323 threshold of OAS clawback territory? Second, what will your RRIF minimum be 5 years from now? That percentage climbs every year whether you need the money or not. Plenty of people are comfortable under the line today and well over it at age 75. Third, do you have a spouse or partner whose income is lower than yours? Hold on to that one, it matters more than you think. If you want to work through these properly, we put together a free resource called the Canadian Retirement Tune-Up. It covers the income and withdrawal questions we're sorting out before and during retirement. It's linked below. Now back to what came off Doug's paycheck before any of that. Here's something that surprises a lot of retirees. If you're working and collecting CPP, you are generally still required to pay into CPP. Doug is 68, already collecting, and about $1,280 came off his pay last year. But between 65 and 70, that part is optional. If you're at least 65 and under 70 and already receiving CPP, you can elect to stop contributing. Before 65, you don't get that choice. After 70, it stops on its own. So there's a 5-year window where it's your call. And most people work straight through it without ever even being told they had that option. The point isn't that one answer's right here. It's that this is a decision and most people never find out that they were even making one. So back to the 3 things Doug and Linda could have done. The first is pension income splitting. This is that third question I asked you. If you're 65 or older and your spouse has lower income, you can generally shift up to half your eligible pension income into that return. Same household income, same part-time work, thousands of dollars of difference from the income splitting. Second, RRSP room. People usually miss this one. Employment income creates new RRSP room, even in your late 60s. Doug's $25,000 of work generates about $4,500 of room for the following year. And you can contribute right up to the end of the year you turn 71. Or if you even have a spouse that's younger, you can even contribute in a spousal RRSP until that spouse is 71. Why does that matter? An RSP contribution reduces your net income directly. So it's one of the very few levers that pulls you back under the OAS line after the income has already been earned. Third, what you draw and when. If you're going to have your employment income this year, that's the year to take less from your RRIF if you have that flexibility, not more. Take the minimum and fill the gap from other income sources, potentially a non-registered investment that's taxed less, or potentially even a TFSA for a little while if you need to. None of this is complicated. They are ordinary planning moves that get used every day. The only reason Doug and Linda didn't use them is nobody ran the numbers before he said yes. This is kind of the thing worth walking through with your advisor and your accountant together, because the tax side and the investment side, they simply have to line up. Let me flip this around, because I don't want to leave you with the wrong impression. Even at 50 cents in the dollar, that money does real work. Every dollar Doug earns is a dollar they don't have to pull out of the portfolio. And the first 5 to 10 years of retirement, that matters more than at any other time, because a bad market early in retirement does far more damage to a plan than the same market 15 years later. They aren't selling into it. Then there's the part that never shows up on a tax return. The health benefits, purpose, structure, routine, somewhere to be on a Tuesday morning. Most people don't realize how much they leaned on these things until they're gone. And that's often what part-time work gives back, more than the money does. So this was never really about whether the money was worth it. Doug would tell you it was. The question is whether he had to give up the $3,700 of OAS to get it. Here's the reframe I'd like to leave you with. Working part-time in retirement isn't a paycheck decision. It's a sequencing decision. The real value usually isn't in the income itself. It's what the income lets you delay. CPP, RRIF drawdowns, withdrawals in the years the portfolio can least afford them. And then there's the question the math can answer. Do you actually want to do the work? That one isn't financial. And it's still the most important one on this list. If part-time work is something you're weighing right now, run the numbers before you say yes, not after. Doug's situation wasn't unusual, wasn't complicated. It just needed somebody to look at it a year earlier. If you'd like someone to look at yours, we're more than happy to do that. Let me tell you what that actually looks like, because I think people avoid these calls without knowing what they're avoiding. It's about 20 minutes, usually a phone call. You tell us what your situation looks like. We tell you what we'd be watching. No products, no pitch, nothing to decide at the end. You also don't need to arrive completely organized. A rough idea of what's coming in, what accounts you have is plenty. I'm Kris Dureau with Green Private Wealth, and thank you for watching.